Welcome back. It is a difficult day for the market, and it seems there's a steady and slow deceleration. By the way, before that, February sales for Maruti coming in 1.18. I think that's higher than our estimates. I'll just try and pull those through for you. The month-on-month figures should come up on your screens as well. Those are Maruti's sales figures at 1.18 lakh units. The stock for now is trading up about 1.5%. More details will come up for you in a second. But to the big story today, which is ONGC. Auction expected to have started at 9:15, carries on through 3:30, about 25% reserved for mutual funds and insurance companies. Two gentlemen join in to talk about that. Amit Rusagi of Antique and Tirthankar Patnaik of Religare. Gentlemen, morning to both of you. Tirthankar, one word from you first on what you're hearing in terms of appetite X of the insurance companies and what kind of prices people are talking about in terms of bids that they intend to put in.
I think the numbers that we've been hearing are anywhere between 295 to 300. That's the band that people have been looking at. That's essentially the buzz that we've been hearing. We have a positive view on the stock, especially with its cheap valuations and the big upside that could be possible from gas increases, and obviously with what will happen with any kind of auto fuel rationalization. So this sort of positive view is across the street, and that's why the bid numbers that we are hearing are in that band, about 290 to 300.
Morning, Tirthankar. Once the auction is done, do you expect 290, 300 to become a base for the stock price though, or do you see the stock coming off?
Not really. We don't see the stock coming off. See, we have a target price of roughly 10 times December 12 earnings at the point at which will translate to about 350 rupees. So we have quite a big upside on the stock. I think even if the stock takes about a year to reach there, in the near term we don't see the number coming down anywhere below 300. That's essentially, as I pointed out, valuations at roughly 9.5 times FY13 and just about 8.5 times FY14 numbers are quite compelling, and there is the obvious upside given the government's strained finances that some sort of rationalization is definitely going to happen on diesel pricing. So clearly there is an upside, and more from a long-term perspective, anything that happens with cane production, if cane ramps up its current production from about 130 odd kbpd to about 160 odd, given ONGC's 30% stake in that you might see upside coming up for ONGC there as well. And lastly, there is this FDP approval for ONGC. If that happens, they will add another 20 mmSCMD, which is roughly 30% of their overall production. So clearly a lot of positives are being built in on the stock. The only negative I can see is if the budget fails to live up to expectations in terms of what happens with at least a roadmap to like I said, auto fuel prices, then the stock might see an overhang. Otherwise, quite a lot of positives built in on the stock. So 300 plus is something that we see coming up very soon.
Amit, what do you think? Do you think some of these issues like oil pricing, subsidy issues might rein in optimism, or the liquidity conditions are such that 295, 300 should be easy?
No, it's not only a matter of liquidity, it's a matter of valuations and triggers going forward. Because if you see ONGC here, it is trading at 9.5 times FY13 earnings. There are a lot of positive triggers in the stock going forward. Number one of that is any rationalization of duties or any rationalization of pricing on diesel, and then government taking steps on curtailing subsidized kerosene as well as LPG by using UID mechanism. Then there will be upside production coming from cane Rajasthan field, as well as any clarity on their KG basin development. So there are so many triggers in the stock. Valuations are cheap, and important thing is that people have forgot one thing about ONGC, is that ONGC is also in partial play on oil prices. If you see there, roughly 40% of the revenues, consolidated revenues, are coming from oil-linked products wherein there is a direct upside to their earnings. So if you see their 9 months earning for FY12, it is roughly 27% higher, despite their net realization in the domestic business remaining same. So basically that is a key which we are highlighting to the clients, that you can play higher oil prices through ONGC and domestic net realizations, which is which is controlled by the government, or you can provide a stabilization in this current scenario. So basically 31-32 rupees EPS, FY12, FY13, the stock is at 9.5 times, makes a lot of sense.
Amit, morning. What kind of one-year target would you hold out on ONGC, though, in terms of a price you think it can settle at, and whether that is significantly higher from where the stock has already gotten to?
See, we have a target price of 335 on ONGC, and this is assuming that government will keep on controlling the net realizations for the company, and there is no clarity on subsidy sharing mechanism. So we are assuming $55 of net realization for the domestic business, which is quite conservative. If there is any clarity on subsidy sharing mechanism for FY13 and going forward, then stock can trade at a higher multiple, more than even 12 times, as well as there will be earnings upgrade coming in. So basically we are waiting for diesel price rationalizations as well as clarity on subsidy sharing mechanisms before upgrading the target price.
Tirthankar, history has suggested that clarity may not necessarily mean a cast-in-stone decision. I mean, the government has gone back in the past both on subsidy sharing and on this deregulation issue. What kind of downside risk is present to people who are looking to buy into this block in ONGC now? Because it could stand to be the biggest hit in terms of subsidy share if the government says, okay, you guys shoulder this, we can't.
I think one has to see how much compulsion has been there. My own teacher, Tirthankar Patnaik, has been talking about this for a long period of time, about duty rationalization. This is something that's expected from the, that's been a big expectation from the market. Obviously, populism has, held sway for now. But look at the numbers. 68% of tax realizations thus far in terms of overall tax realizations. In terms of fiscal deficit, we've already crossed 105%, and this is about the April to January period I'm speaking about. We have another 2 months more to go. On the revenue deficit, we are about 108%. So, fiscal balances are not really in the comfort zone at the moment. So while one can see a half measure, as happened in something that happened in June last year, where you had a hike, but you also had simultaneously a drop in customs and excise duties, which really didn't hurt government's realizations, net realizations. This time, I think the fiscal balances are slightly more strained. So downside to that extent is limited, if at all it happens. Let's not forget that there is some support for ONGC also in terms of the free float. The current free float, when it rises from about 60, what is it, about the government share will go down from 74% to about 69% or so. That will essentially raise ONGC's weight in across all the benchmark indices. So you have passive buying, or passive assets under management of really $14-15 billion riding on Indian markets, either through direct Indian exposure or through MSCI, where India has, or the emerging markets exposure, where India has about 6.5% or so overall weight, and also on Nifty. So when ONGC's weight rises, this passive buying should also act as some support. So clearly downside that way is fairly limited. I would not see the stock going down below 280 levels given all these positives.
Thanks guys for joining in on ONGC. Consensus that issue should get done pretty smoothly with no hiccups. The stock has been holding